Hello, everyone, and welcome back to Markets in Focus. Today is February 10, 2026. My name is Razan Hilal. I'm a market analyst with Forex.com. We're going to go over key charts in focus between the US dollar index, the euro dollar, and the dollar yen. And then we're going to be transitioning towards precious metals, gold and silver, then towards crude oil, and then ending it with US indices. I'm happy to take any questions at the end of the webinar due to time constraint. We have a 1 minute disclaimer running right now, and once it's complete, we'll be diving straight into the charts. Okay, hello everyone again. So as I mentioned, we'll be starting with the US dollar index, which is back under pressure near the 96, the critical 96 support. I'm going to go back to why this is a critical support on the chart as it aligns with the lower bound of a channel that has been respected on the charts all the way since the lows of 2008, which makes the 96 mark a critical, the 96 to the 95 zone, a critical level that possibly defines either the long-standing bullish bias continuation or a potential structural shift on the charts, extending bearish bias on the US dollar index and also extending gains across major currencies on the charts. Now, if we drop to the weekly time frame, we can see an extended wick all the way down towards the 95.50 before closing back towards the 97 mark. And this wick demonstrates the inability of bears to be able to sustain these lows and more bullish dominance on the charts, which is putting or keeping the US dollar index in a bullish bias against the currency market. But of course, given the latest pressures on the US dollar index, and also as we have Chinese reports stating the diversification away from US treasuries to diversify also away from any change in policies. And that is also ahead of the Wednesday's non-farm payroll data, which is also increasing cautionary expectations given the latest job openings dropping to lows last seen in 2020. And we also have mixed expectations for the US CPI reports coming in on Friday. So this is also keeping the US dollar index in under pressure near the 96 mark. Yet if we do manage to have a clean hold back above the 98 mark, the 97 and 98 marks, we can be expecting potential neutral to bullish bias extending on the charts with key levels on the upside between the 99.50 and the 100.40 mark to be able to confirm potential long-term bullish bias continuation on the US dollar index or not. As long as we stay or extend the consolidation within the zone, we remain in the neutral to bullish bias. And if we do manage to hold below the 96 to the 95 zone, breaking firmly with daily to weekly close below the bounds of this uptrending and respected channel since the lows of 2008, then we can be expecting a structural shift in the DXY, possibly extending all the way down to the 92 to the 89 lows, extending gains on the euro and major currency pairs towards their 2022 highs. Now, if we look at the euro dollar, we also have a similar pattern over here on the weekly time frame, extended wick to the upside, also demonstrating the inability of bulls to hold these gains and more bearish dominance as we manage to drop back below the 118 mark. Now, price action is also making its way back towards this critical zone, which is between the 1950 to the 19 mark, which is also reasserting or trying to reassert bullish bias on the charts over here, also ahead of the non-farm payroll and the CPI reports for this week that are expected to inject volatility risks across the charts. Now, if we do manage to have a clean hold above 1950, we can be expecting gains back towards this high that also is aligned with a trend line connecting consecutive higher highs between June 30, 2025 and September 2025. And the clean hold above this mark, which is the 120.80 mark, is expected to extend gains all the way to highs last seen in May 2021, or we can say in 2021 and in 2020, which is near the 122.50 to the 123 zone. and a clean hold above this level is expected to extend gains all the way towards the 125 level, which is aligns with previous high last seen in 2018. So this is the upside potential for the euro dollar, and the downside potential remains constrained between the 117 to the 116 marks, or the 115.80, 117 and the 115.80 mark over here, which can open the way towards lows between last seen across 2024 and 2023, which is near the 113 to the 112 mark for potential dip buying opportunities. Now, so far, we have the RSI holding above the neutral 50 zone, which is still asserting that bullish bias, needing that confirmation above that critical zone to be able to extend the gains. Now, if you look at the dollar yen, we also have a similar situation over here, also especially following the snap elections that happened throughout the weekend. That's also lifted risks for potential dovish policies on the charts, yet that also translated towards a positive impact on the Japanese economy, which is keeping the yen on hold with the US dollar index. Now, also in line with the wick demonstrated on the DXY and the euro dollar, we also have that extended weekly wick on the dollar yen that bears did not manage to hold or keep their grounds in all the way down towards a 151.80 to close back above that critical support level that has been intact on the charts all across 2026 and since December 2025. So over here, looking at the price action, we're at the upper end of a channel respected since the lows of April 2025, and the clean hold above this pound and above the 157.50 mark is expected to extend gains back towards our previous resistance near the 158.80, which was also the high of January 2025, for potentially extending gains up towards the highs of July or of 2024, which is near the 161.80 mark, for extending a longer term, steeper bullish forecast for the dollar yen, which if we do manage to have price action approaching this level, we might be expecting also steeper intervention risks on the horizon. Now, from the downside, if we do manage to have a clean close below this critical support zone, which is between the 154.80 and the 153.80, we can be expecting drawdowns to extend back towards 151.80 to the 149.60 before possibly extending the steeper bearish bias on the charts back towards the 140 zone for the dollar yen. All right, so moving down to the gold chart, the gold and silver charts. Now, first, I'm going to demonstrate the 3-month time frame on the gold chart, where we can see an exponential breakout above the bounds of a contraction extending from the 1980s on the charts, with the breakout between January 2025 all through January 2026. Now, this breakout is very steep on the charts, which is raising risks for potential steeper drawdowns, possibly aligning back with the upper bound of that consolidation. And this is a scenario also similar to the silver chart, where we have that steep breakout, also opening or extending drawdown risks all the way down towards the upper bound of these approximately 45-year consolidations on the charts before we can continue these bullish uptrends. Now, back to the gold chart over here. And in a similar manner also to the silver chart, we can also see the relative strength index indicator hovering at overbought levels last seen over here in 2010 and in 1980 that preceded steep drawdowns or extended drawdowns on the charts, which is also why we have extended drawdown risks on the horizon over here, despite the steepness of these curves. So if we drop down here to the weekly time frame, we can see that the gold chart is respecting Fibonacci retracement levels of the trend, originating from the breakout of that 45-year consolidation, which aligns the latest drop downs here with the 382 near the 4,420, where we had that latest extended wick on the chart back above the 5,000 mark, which is currently facing the 5,100, to be able to assert itself for further bullish bias, possibly towards the 6,000 and 6,800 marks on the charts. Or if not, if we do manage to close back below the 4,700 mark, we can be expecting a drawdown back towards 4,400 or the 50%, the 4,000 psychological mark for potential dip buying opportunities, with the golden 618 being the 3,700 to the 3,500 mark, which was a resistance level for approximately 5 months across 2025. The silver chart has a very similar scenario over here with respected Fibonacci levels on the horizon. over here between the 74 and the 64 mark. Clean hold below 64 can possibly extend losses down to retest the upper bound of that consolidation, possibly between 55 and the 48 zone to be able to recharge that momentum. If not, if you do manage to continue from here and close back above the 90 mark, we can be expecting silver to extend gains back towards 100, 120, and potentially up towards the 200 marks for 2026. This is for the gold and silver charts. As I mentioned, I'm happy to take questions at the end of the webinar due to time constraints over here. Following the gold and silver, I'm going to jump to the crude oil chart, where we have a bullish bias extending up across 2026. We can see it more clearly on the daily time frame, where we have price action respecting the bounds of an uptrending and parallel channel since the lows of December 2025, where we're currently holding also above the 60 barrier now, despite also the decreasing tensions in the Middle East and decreasing tensions for supply disruptions for crude oil. Overall, we can still see upside hedging activity with the global uncertainty going on, and with the price action also holding near critical breakout levels, which is between the 64 and the 66 mark. Now, the 66 mark aligns with the upper bound of a descending channel since the highs of September 2023. So we have an overall a more than 2-year bearish bias over here on the charts, and the clean hold beyond the 66.80 mark is expected to extend gains towards the 70 level, the 74, and further towards the 80 mark, in line with highs last seen in 2025, which may open the way for potential bullish structural shift for crude oil prices on the chart. Now, from the downside, if we do manage to break below that 2026 bias and uptrend so far, connecting all these consecutive higher lows, that is below the 62.20 level, we can be expecting potential drawdowns back towards the 61.50, the 60 zone, and the 58.70 level, lining with the mid zone of this channel before exposing further downside risks towards the 55 zone. That was a support level extending on the chart since April 2025 that can either have or represent another dip buying opportunity or rebound opportunity for crude oil prices, or a steeper drawdown to the lower bound of that respected downtrending channel since over here since July 2023 near the 49 mark for potential dip buying opportunities. Now, last but not least, we have the US indices, where we have Nasdaq pulling back from the 26,000 zone over 5 times in a row since October 2025, which is adding pressure on the charts, also in line with the latest rotation out of the AI focus sectors and stocks. Now, this is also creating a divergence with the Dow Jones chart, which is attempting to break out above a consolidation that has also been respected on the chart since the bullish rebound from the 2020 lows. And looking at, I'm going to drop down to the monthly time frame here. We're attempting to have this bullish breakout above the 50,200 mark that can extend gains towards the 51,200 and the 53,000. The critical support level over here, should that diagonal play out with a steep drawdown risk, is the 48,800 to the 48,200 that can expose a drawdown at least the highs last seen between 2024 and 2025 near the 45,000 mark, that can either determine a bullish rebound or a steeper drawdown scenario on the chart that can be replicated across major stocks and indices globally for potential reset before we can realign back with the trends and healthy momentum trends across the charts. Thank you for attending this webinar. We'll be back in 2 weeks. Happy to answer all your questions.